So now we progress to the triple candlestick lines, and we're going to be looking at the morning star. It's a 3 candlestick signal, and the market's in a downtrend. First candle, long black real body. Then the second candle line's a small real body. That doesn't or slightly overlaps the first candle. The classic morning star actually has these 3 real bodies and none of them overlap, but from my experience, it's fine if there is a little bit of overlapping. You're definitely going to get an overlap in Forex. The second candle needs to be small. I don't have a percentage on that, but it needs to be small because what we want to see is this first candle, the bears are in charge. The market is still making a lower move, but the real body is showing us the bearish momentum is flagging. It could be a black or white real body. So the Japanese would say actually the decline might be exhausting itself. But the turning signal comes on the third candle with a white candle that moves smartly into the black real body. Okay, the bulls now dominate. It's a 3 candlestick signal.
And how is deeply defined in this one?
Okay, the question is how is deeply defined? More than halfway. The lowest low of the 3 candlestick lines becomes our support area. So here we have a morning star pattern. The low of the morning star is a support level, as shown here. Okay, here we have a morning star. This is the Dow a little while ago. What was fascinating, I'm going to make another red semicircle on the left side of the slide. And what happened a few sessions after that morning star? Another morning star. Right. And we're going to be looking at a strategy tomorrow where we call it a crack and snap, and don't worry about taking notes, but the market breaks a support level, as it did here, and then gets back above that broken support area. That's a really good buying signal. But this was a morning star, and that white candle also was an inability to hold below the support area. Remember one of the slides I showed you in the introduction with Bear Stearns? The Bear Stearns collapse. It broke under a support level on the S&P and got back above it. That's usually quite powerful. Same thing here. Market broke under support with this long black candle. What gave us a little hint over here that this bearish momentum was easing? Small real body, and this is the completion of the morning star. The bulls took over. Okay, the low of the morning star as a support level. Same thing here. Market broke under support with this long black candle. What gave us a little hint over here that this bearish momentum was easing? Small real body, and this is the completion of the morning star. The bulls took over. Okay, the low of the morning star as a support level. Okay, here's a morning star. This happens to be a 1-minute chart. You wouldn't be able to tell that by looking at the chart, right? It looks like a daily chart. Right, the really active equities are going to look like this. They're fine to use very short-term signals. Okay, so here we have on the Forex a morning star. Now, what I wanted to show you on the left side of the slide, where the semicircle blue came up on the left side, that's a variation on the morning star. The classic morning star has one small real body between the 2 real bodies, the black real body and the white real body. However, it's perfectly acceptable for the morning star to have a series of small real bodies. Okay, they could be under the real body of the first candle or just hovering within it. And again, the Forex, it's okay to have the opening and closing the same. But this could be 2, 3 candle lines, and then you have a tall white candle that goes deeply into the black real body. In fact, this is a really good signal because The morning star is a nice bottom reversal signal, but it's sort of a V bottom. The market does this and does that. If you have a series of small real bodies, what's happening to the base? Expanding on a base, yeah, and that's usually a better way for market to rally. You're expanding on the base. Here's an issue with the morning star, and some of these candlestick signals have this problem. I've mentioned it before. We'll talk about it tomorrow, but this is a good slide in looking at it the reason I'm mentioning this now, it's a good example of this. Look at where the morning star is formed. Nice tall white real body. Did it get deeply into that black real body? Sure. Now, it was questioned before is where do you buy this? You don't buy in that morning star. Why? Yeah, think about the risk reward. If you're buying it here, your target might be different, but my resistance would be up here. That's not a good trade. And this is why you can't trade with candles in isolation. Somebody would say, this is a great morning star, tall white candle that really moved off the lows, moved deeply into the black real body, but it's a lousy trade. Okay? Use the low of the morning star as a potential support area. So if the market gets down there, here we have a piercing pattern, nice bounce back over here, confirming the low of the morning star. So whenever somebody asks me, is this a good signal or is that a bad signal, you have to see where it is within the market's context. Now we're looking at 3 candlestick lines. We're looking at the bullish signals. Here we have a rising, 3 advancing white soldiers, essentially just 3 tall white candles. And ideally, the market could be in a downtrend, but this is also good if it's in markets in the lateral trading range. They should be tall white real bodies. The last 2, they open within or over the prior white real body, and each candle should close at or near the high of the session. It's a potential bottom reversal. It's also good if the market's moving up. It's a bullish continuation signal, but mainly as a bottom reversal. And it's not used as support or resistance. And the issue with this pattern, including some of the other patterns, and some of them that we haven't even gotten into today, an issue is by the time you get the signal, it's late. Right. So one of the things I have found from my experience, this is not a very common pattern, but I really like it because it really gives a sense of the dynamics that the bulls are really taking over, is frequently the market will correct maybe 50 to about 62%, the Fibonacci retracement, 61.8%. So you could have the 3 advancing white soldiers, and the market will very often come back kind of towards the middle of those 3 candle lines. It's a very healthy, very normal retracement, 50% retracement. And we're going to actually look at retracements tomorrow. We're going to have a whole section where we talk about Western technicals, about retracements. But I figured since we're talking about the 3 candlestick lines, the bullish candlestick lines, the morning stars, the 3 candlestick signal, this is a 3 candlestick signal. Now we're going to shift over to the bearish candle signals. The evening star, flip side of the morning star. The market is an uptrend. First candle is a long white. Second candle, small real body, black or white. And this is a classic evening star where the real bodies don't touch. It's okay for the real bodies to overlap slightly. And the third candle line gets deeply into the first real body. Okay, the bears are now in control. And the resistance area is the highest high of the 3 candlestick lines. And let's think about the psychology of the market based on this candlestick signal. Obviously, bulls are in charge. This spinning top, small real body, reflects difficulty. The Japanese would say difficulty to rise. Right? And the black candle, which really should be a little bit more deeply into the white candle, the black candle is the turnaround selling candle. That's the one that shows, that proves the bears have taken over. Now, in the history of candles, when I was doing research into candles, one of the founders of, and there's a lot of hype about candlesticks. Some of you may have heard of Homa. He was a famous rice trader in the 1600s, early 1700s actually. Again, I don't want to spend time going over the history, but candles weren't developed in the 1700s to trade rice futures. There wasn't even a high and low back then. What the candles evolved from was based on trading in the rice futures in Japan. Back in I think the mid-1700s, they traded rice futures in Osaka, Japan, and they were called empty rice contracts, rice that wasn't there. And there was a very famous trader, Homa, and essentially, once again, I don't want to spend time to get too much into it, but he understood the psychology of the market. He made a fortune trading rice using market psychology. And what happened is a lot of his insights were translated into candles. So, for example, in one of his writings, the Japanese actually call bullish candles yin and bearish candles yang. So, in one of his writings about trading rice, he said, when yin reaches an extreme, there is stillness. This stillness gives rise to yang. Okay, that's the evening star. So a lot of his understandings about the psychology of the market ultimately wound up to be candlesticks. But isn't that a great way of putting it? Visually just showing us how the market is shifting from bullish to a little less bullish. It's still slightly bullish because the market's still making a higher close up here. Yeah, but the small real body is showing us the momentum of the force of the bulls is dissipating somewhat, and then the bears have taken over. And this, again, is what the candles do, visually showing us the shifting psychology, the shifting relationship between who's gaining the upper hand between supply versus demand. So here we have an evening star. Candles don't call all reversals. And I wanted to mention that because when you walk out of the seminar tomorrow, you're going to really know the candles inside out. And you're going to go and look at the charts and say the market turned, and I didn't see it. What did I miss with the candles? The candles don't call all reversals. So, let me show you. This is an older slide, but I like it a lot because it brings out an important aspect. Here we have a classic evening star. This happens to be the NASDAQ. Now, that's a bearish reversal signal, and it's particularly ominous. And when I say ominous, meaning the likelihood of a reversal, doesn't mean the market's going to fall out of bed like it did here. So, reversal signal, confirming a resistance area. But I wanted to show you, this. The market reversed here. There were no candlestick signals here. This is not an evening star. Okay. The first candle for an evening star, ideally, should be a long white candle. The second one should be relatively small. This did have the black candle, but the first two candle lines are not correct for an evening star. There were no turning signals here. There are more advanced candlestick signals beyond the scope of this session. This actually would call a bearish separating line. But as far as what we're talking about here, and it's true whether you know all the candlestick signals or not every turn is going to be called by candles. So don't worry if you missed it. Yeah. Okay, here, again, just wanted to show you in the futures market, an evening star. Also, even if you didn't recognize the evening star, what were the last two candlestick lines? Black wrapping around the white? Bearish engulfing pattern, yeah. Okay, now this one is interesting. This is, first of all, the two candle lines in the red semicircle. That to me would be a bear Hatomy, small real body and a big real body. They're both white candles, right? The confirmation, though, see, with a Hatomy, remember, it turns the trend from up to like more neutral. The bears haven't taken over. The coup de grace came on this black candle, first of all, because of the gap down. We'll look at gaps later. But as far as the evening star is concerned, this is a black candle that got deeply into the white candle. Now, the reason I wanted to show you this particular slide is because usually with the evening star, the third candle is a really long black real body. But more importantly then the size of the black real body is how deeply it gets into the white real body. Does it make sense? Even if his third black candle was not a black, that's not a real small black real body, but even if it was a relatively small black real body, let's say it was this one, I would still view that as an evening star because the market intruded deeply into the bull's territory. And this brings out a very important point, that you need to be a little flexible with your reading of the candlestick. Think about what the psychology of the market is. Even if it's not a long black real body, did the bears get deeply into the bull's territory? Certainly. And there was an example like this when I was doing my initial research into the 80s. And as I had mentioned, I'd be faxing back and forth to many of the traders in Japan. The head technical traders at a lot of the brokerage firms and so forth. And I had a question similar to this. I said, would you view this as an evening star? And this is what they wrote back to me with facts. Okay. We have found our discussions very interesting in the sense that you try to keep your readings specific while we try to keep them as flexible. So not as to exclude all possibilities. This, we think, may be traced to differences between Westerners who prefer to be precise and definite, and Asians who like to be flexible. Okay. And I think this was his really nice way of saying, chill out. So, even if it's not a long black real body, it was the same thing with the Morning Star. The Morning Star, black real body, small real body, black or white, and then a white real body. Normally, a long white real body gets deeply into the black candle. Even if it's not a tall white real body, as long as it gets deeply into the black real body. Evening Star and flexibility. Okay, chill out, be flexible. Did that black real body get more than halfway into the white candle? No. So, on the scanning software, by the way, this would not be picked up as an evening star. With the scanning software, one of the challenges, you have to be specific. This is not an evening star, so it would not be picked up as an evening star. However, why do you think I would be all over this trade from the short side, or at a minimum, certainly lighten up a longs? A resistance area. Exactly. Okay, by the way, this is a dark cloud cover over here. White candle, and we're going to look at this in more detail tomorrow when we talk about trends, but may as well touch on it now. White candle wrapping around the black candle. Why is that not a bullish engulfing pattern? Not much of a downtrend. Right, there's really no downtrend. Right, a bullish engulfing pattern has to come after a downtrend. Evening star as resistance. Okay, here we have a variation of the evening star. If you remember, we saw the variation on the morning star before. Black real body, series of small real bodies, and then a white candle, kind of a rounding bottom. Same thing here. The rally is faltering. So we have a white real body, series of small real bodies not touching, or it's fine if it's slightly inside the white candle, and then this black real body over here. Reading the market's message quickly and accurately. That's what the candles are all about. Dark cloud cover and the green arrow on your left. The red arrow on your left is long upper shadow, small real body. Opposite of the hammer, shooting star. What's confirming the resistance area? Black wrapping around the white. A bearish engulfing pattern. Okay, and this is a 1-minute chart. And just to relay, these were all reversal signals in a maybe 10, 12 cent trading zone. You think there's resistance there? Right, of course. Okay. Now we go to 3 black crows. The opposite of the 3 soldiers. The Japanese say the cawing of a crow presages calamity. So you have 3 black candles. After a fairly substantial rally, And the opening of the last two should be within or below the prior black real bodies. And each candle should close at or near its lows. Okay, we don't use this as a resistance area. And just as the downside, by the time you get the signal with the three soldiers, right, by the time you get the signal here. So although there are candlestick signals that are interesting, some of them you really can't do much with. And this one, again, it's pretty rare, so I don't see it that often. I haven't seen 50% retracements into this. The three soldiers I see frequently, the few times I see them, we do get, so the three soldiers, the market move up. The three soldiers, I do see corrections. With the three crows, a lot of times I don't see corrections. So, and once again, there might be things to do with options, you know, if you see something like this. Okay? And here, right at the same resistance area, even if you didn't know these were bearish engulfing patterns, even if you knew the basics about reading individual candlestick lines, we could see that the bears each time, and this is not a dark, everybody see why this first one is not a dark cloud cover? Right, so that to me is not really significant. But then you start getting this, and we should recognize the bearish engulfing pattern. But even if you didn't, black real body at resistance, black real body at resistance, black real body at resistance. Not good, unless you're bearish, right? Okay, you didn't have to be hit over the head with something like this. The Japanese say, if heaven drops a fig, open your mouth. Okay. Unless you're in New York, we have lots of pigeons. Okay, this is one of those times. Bring this all together, reading the market's message. Market's descending. Okay, actually we saw this slide before, but now we're going to be looking at the dual candlestick signals. So we looked at this with the single candlestick lines when we were finishing that section up, small real bodies, but now we could add what we learned here. This white candle wrapping around how many? 4 real bodies. Right. Candle line 1 is a doji, but it's 25. Candle line 1 is a doji. The real body is so small, but it's also 25% or less than the first candle. So what does that make that? A bear Harami, right? Exactly. Number 2, it's actually part of a 3 candlestick signal. Evening star, that's right. And 3, she'll have that bearish engulfing pattern. Right. So before we looked at them from this single candle perspective, the doji, the black candle, another black candle, tall white candle, but now we're looking at it from the perspective of dual and triple candlestick lines, the bullish engulfing pattern, presaging a rally, the Harami, the evening star, and the bearish engulfing pattern, all at the same resistance area. Okay, here, we saw this before, the market rising in agony. Moving up, small real bodies, doji. But over here, all right. Now, that's a bearish engulfing pattern, confirming resistance, right? Okay, confirming a resistance area. Now here, we have a bullish engulfing pattern, but we should not trade on that bullish engulfing pattern. And the reason for that is because of the gap down. And we're going to look at continuation signals in a couple of minutes. You see how the market gap down? Okay. That gap becomes resistance. So once again, the idea of candles in context. You could have a bullish engulfing pattern. In one scenario, you can think about buying it or covering shorts. Another bullish engulfing pattern, in a situation like this, you shouldn't do anything with it. And we're going to go over windows in a couple of minutes, but I want to kind of wrap this portion up now before we look at continuation signals, which includes windows. Okay, let's go over what we learned. The bearish and bullish and bearish engulfing patterns, white wrapping around the black, black wrapping around the white. Okay, we've looked at Differences, just very briefly, this is not a session on Forex, but differences in candles in the Forex and non-Forex. Because the Forex market is 24 hours, it's okay for the dual, and I didn't get into triple candlestick signals, but true for them also. It's okay for the opening and closing to be the same. The piercing pattern of the white candle gets more than halfway into the black real body. Simplifying candle analysis. Remember the piercing pattern? We have the in neck, on neck, and thrusting. Don't have to worry about it. All you need to know is white candle gets more than the middle of the black real body. Dark cloud cover, market's ascending. White candle, market gaps higher, the bulls are happy, and then by the end of the session, it not only closes lower, but it closes deeply into the white candle, and the bulls are probably running scared at that time. Now remember, most of these candlestick signals can be used as support or resistance. The higher the higher the bearish engulfing pattern should be resistance, the lower the morning star should be support, and so forth. Okay, bull and bear Hadarmi. Big real body followed immediately by a relatively small real body, 25% or less. Okay, reading the market's message with dual candlestick signals we saw in the last few slides. How to do that. Triple candlestick signals, morning and evening stars. Morning star, the market's moving down, and the small real body showing us the bears are losing momentum, and then a white candle that gets deeply into the black, the bulls have taken over. Flip side for the evening star. And then being flexible, chill out with candlestick readings. And then we also looked at soldiers and three crows. Okay, the three advancing soldiers, three black crows. Downside is by the time you get the signal, there's not really much you could do with those particular candlestick signals. So we're moving up the steps a little bit more. Here we have the continuation candles. And continuation means that the trend is supposed to continue in the direction that it had before the signal. So one of the continuation signals is called the rising and falling three methods. Very simple. A rising three methods is a long white candle, a series of small real bodies, black or white, that are within that first candle, including the shadows. The market is correcting. And then the last candle, it doesn't have to be a tall white one, normally it is, but it's a white one that closes above the first candle's close. The Japanese would say with this correction, the market is taking a rest from battle. In the West, we would say the market's relieving an overbought condition. Okay? So falling three methods, the market is moving down, then the market ascends or trades sideways. This is a classic falling three methods. The market has a series of three white candles. It could be black candles, it could be trading sideways, it could be up to 5 candles. The turning signal that telling us the trend is continuing down is the last candle closes under the first candle. The Japanese would say the bear chase begins then. So let's look at an example of this. So here we have a rising three methods, white real body, and these are really a series of like Hadarmi, right? Small real bodies within the prior candle, and the last candle, the tall white candle, and once again, it doesn't have to be a tall white candle, as long as it closes above the first one, is a bullish continuation signal. So you can see the trend before that candle pattern is up. A continuation signal means the trend should continue in that same direction. And a bearish falling three methods. And the reason it's calling falling three methods because normally there's 3 candles, but it doesn't matter if it's 2, if it's 4. But as long as those real bodies hover within it doesn't have to be the real body. With the Hadarmi, it's real body, small real body, and the bigger real body. This is a little looser in the definition. It's real bodies, and it could be within the shadows. It doesn't have to be within the real bodies, as long as it's hovering within the shadows. Okay, so this, maybe if this was a longer black real body, let's say we had a black real body up here. Let's imagine the black real body was up here. And this close was down under here, that would be a falling three methods. It wasn't, but I just wanted to show you what it would look like visually. Okay, so this is one of the continuation signals. The completion of the rising three methods The question is, when would you get in? The completion of the rising free methods is on the white candle close above here. This is a trade you probably should not take because you're right near a resistance area. See, we're just looking at defining candlestick signals yet. We haven't really looked at how to really harness them correctly. Okay, now over here, this may not be a bad trade. We got the completion of the pattern. Based on this, is it near a support area? No, so it might be perfectly fine to sell it over there. Okay, now we're going to look at my favorite candlestick signal. Okay. We'll see you next week. Bye, bye, bye. As people go against the door to keep me in here. Okay, so this is my all-time favorite candlestick signal. It's windows. A window is the same as a gap in Western technicals. This was the expression that, remember I said the Japanese lady who worked down the hall from me had the chart book and she guessed, oh, we have windows. A window is the same as a gap high, a rising window. And I'm going to show you how we could use windows. A rising window, gap higher, same thing. A falling window means a gap lower. The Japanese will say, and by the way, windows are continuation signals. That's the session here. That means the market is moving up. Then we have a rising window, a gap higher, the market should continue moving up. The market is moving down with a falling window. Before the falling window gaps down, we should be looking to sell on rallies. With the rising window, we should be looking to buy on corrections. With the falling window, we should be looking to sell on rallies. And I'm going to show you how we can use the windows to do those two strategies. There's no gaps in the Forex market, or few gaps. So the Japanese would say corrections stop at the window. And what that means is when we have a rising window, any pullbacks from the rising window should stop at the rising window's potential support area. So the market gaps up, and what that means is there's a price vacuum between, assuming there's a daily chart, it could be intraday, it doesn't matter. Let's assume it's a daily chart between today's low and yesterday's high. There's no trading. That's what the definition of a gap is. So the gap becomes a potential support area. Now, I made the lines, I made one of them a dotted red line, and the reason I did that is because that's the bottom of the window. That becomes the most important support area based on a close. As shown here, the market broke under the rising window, but it didn't close under it. So the rising window, the whole zone becomes support. The major support is the bottom of the window based on a close. So here we have a small rising window. And what I like about the windows, it shows such a shift in psychology. First of all, you're going with the trend, which is always nice. A rising window is in a bull trend, so you're going with the trend. And there's so much buying demand that the market gaps higher. And those who missed going long are kicking themselves. It's human nature. That's what technicals measure, human nature. So the market, very often, when it retraces to the rising window, becomes a support area. And I like small windows. We're going to look at small windows in detail in a little bit. But what's good about a small window, as opposed to a large window, what about the support zone? If you have a large window, right, a small window, a much tighter support zone, exactly. Now, here we have a bunch of W's, and this is the candle scanning software. And the reason I like using it is because sometimes small windows are hard to see. So a green W is a rising window, a red W is a falling window. So here, for example, the shadow. So the top of the upper shadow is over here, the bottom of the lower shadow here. It will be very hard to see, but you can see the green W shows us the rising window. There's a rising window here, over here, and I don't know if the market, if it closed below it, over here, probably very, very close. Now, definitely on this rising window here that I'm circling, the market moved under an intercession, but I don't know if it closed under it. It has to be a close under the rising window to say this window support was broken. Here's a rising window that became potential support. Now, obviously, it's not going to work this well in all instances, but I really like it as a potential support area. Now, one of the questions I'm asked is, because the window is so good, if you break the window, say we break the window support. So we have a rising window, that's a support area, the market breaks under it. What if the market then rallies and comes back to that rising window? Is that still support? And the answer is no. Once the market closes under the window, I don't use it as support anymore. So, for example, here, a rising window became support. The market closed under it here again. Now the market sells off, comes up, and what do we have here? Another rising window, right. So, but this area becomes support only because the rising window, once the market breaks the rising window support, I don't look at this window anymore. It's done. The analogy I like to make is like if you have a broken window in a house, it's not good anymore. Same thing here. And interestingly, this is Amazon. Notice the, what do we have here with the red arrow? Right at the window's support area. It's in the support area, yeah. Now, the thing with a window is that you just don't know how far in the window it's going to get. That's the problem with a big gap, because that whole zone of support, all we know is the major support is the bottom of the gap. And just starting to, again, getting a feel for candles in context, this is going to be part of trade management tomorrow, looking at the candle through the overall technical picture. A shooting star, but why would we not sell in that shooting star? A gap higher. So if you're selling there, you're selling right at a support area. Not a good trade. Again, just because you get a candlestick signal doesn't mean you buy and sell in every candlestick signal. Okay, a little hard to see here. But anyway, another shooting star confirming resistance. But what do we need for that bearish confirmation of that shooting star? And I'll give you a little hint over here. What do we have there? A rising window. So certainly if you were long, especially with the doji as resistance, the shooting star in a group of candlestick signals. And if you were just looking at that in isolation, you say, hey, we have a shooting star and a doji at the same resistance area. But think about this rising window as potential support, which did hold for a few days. So again, maybe thinking about positioning your trades, maybe lightly selling on the shooting star, but I really wouldn't be fully committed, and then we'd have to think about the risk reward until the close under the rising window. Okay, how education saves you money. Okay, that's why you're here. Make you money, save you money with education. And remember, we're going down the path of education here. And the red arrow there, we saw this before, we have a dark cloud cover. Became resistance, okay? What do we have in the second red arrow? Right. Now, say you knew enough to be dangerous about the bearish engulfing pattern, you'd be selling there right at exactly the wrong time. Why? The rising window, you're selling at support. And look what happened after. And interestingly, okay, the rising window. Let me show you something really interesting in Apple. So this was the rising window. This was that same rising window. Here's that bearish engulfing pattern where we knew not to sell it, okay, because of the rising window. I don't show it here, but the rising window is over here. Remember the hammer we talked about early on with Apple? And look where the hammer emerged. This was before Apple went up to the hundreds, $200. Again, candles don't give you targets, but this was a major bottom. So we had some warnings here of the doji, the bearish engulfing pattern, but the rising window was support, so we'd have to wait for a gap down. But we certainly had some clues here. The market was really running out of steam. Market pulls back, has a hammer. This is the rising window support area. Have a hammer. Now, we talked about this candlestick signal before. We looked at this before. Black wheel body. Oops, black wheel body who's in charge. Go here. Black wheel body who's in charge. Bears. Next session, what happened? Now, when we talked about this before, we talked about the double candlestick patterns. We didn't know about the bullish Hatterme. There's actually a bullish Hatterme. Okay? But even if you didn't know that, the law of the hammer was support, and the hammer was right within the rising window support area. Would you have loved to see this? It was just such a great signal. Now, just as the rising window becomes support, the falling window becomes a resistance area. Bearish continuation. The market is moving south, we should be looking for rallies to sell. The rallies should run out of steam within the falling windows resistance zone. Pivotal resistance is the top, the red dotted line, where I say the most important resistance area. That's the pivotal resistance. Now, of course, and I'm not sure if I have any ETFs here, but if you have ETFs or markets where you have gaps all over the place, or you trade ADRs, the windows aren't as valid. So the most important resistance area is the top of the window. And so here, a very small, as I mentioned before, I really like those small windows because it shows us, it gives us a very tight potential resistance area. On the ETFs, if you have ETFs like the China or an overseas market where you're gapping because the markets are open overnight, the gaps don't mean as much, right? And thanks for mentioning that. Yeah, the ETFs, if you have relatively few windows, they're fine, but a lot of the popular ETFs, are based on the overseas markets. Okay, here we have a small window. Over here, the window acted as resistance. Okay, these doji, no reason not to sell here. This looks like, I don't know if this is a rising window, but assuming it's not, if I saw these doji here, if the window's resistance, it'd be a reason to sell, but this is what stops her about. Once the market gets above the window on a close, that's a bullish breakout. This is a falling window as resistance. Once the market closes above that, it's a bullish breakout. The resistance is broken. Okay. Now, if the market had pulled back here and then starts moving up, this window is no longer resistance. It's broken. Everybody see that? Once the window's resistance is broken, you don't use it as resistance anymore. Once the falling window's resistance is broken. Okay, so here we have a falling window. Okay, a bearish Harami. And in fact, even if you didn't recognize the Harami, what do we have here? A doji. So I would never say how much is that doji in the window. Never. Never. Oh. Somebody else said it. They were ventriloquists. I just moved my mouth. And I wonder how many young people even know what that song is, right? How much is that doggy in the window? Yeah. What was that? A typewriter, yeah, a typewriter. Okay, here we have a small falling window. And this is why it's nice. This is why it's nice with the candlestick recognition. You see that red W? I don't think even I'd be able to pick up that visually that it was a small a window there. A window is a window is a window, even if it's a cent or two. Okay, there's another window there in the green W. It didn't work. On the right side, rising window, didn't work. Now, I really like breakaway gaps, and this is a term used in the West. Essentially, it's a gap away from an important support or resistance area. So remember, a gap is the same as a window. And what's nice about this is not only did the market gap higher or lower, but it really gapped away from a significant technical area. And that really helps get the market going a lot of times. So here we have a rising window that gapped above resistance. And we'll be talking about change of polarity. I made reference to it a couple of minutes ago. Sorry, I think we're talking about, change of polarity. We made reference to it a couple of minutes ago. We're going to talk more about it tomorrow. But one of the reasons I like this so much is because change of polarity, old resistance becomes new support. So we have the rising window as support and old resistance becoming new support. And again, we'll be talking about the change of polarity tomorrow, but this is one of the reasons I like gaps, breakaway gaps. And a breakaway gap can also be with an angled trend line, as shown on the right over there. So as long as it gaps away from a technically significant area. So here, the market gaps down, And again, think about those longs who were in the market, and the market gaps down. They're hoping for support to hold, and not only does the market try to bounce for support, it just blows right through it. So they'll be thrilled, to get out on any rallies too near that gap. So I really like breakaway gaps. Here, same thing. Little rising support line. We'll look at angled trend lines tomorrow. Market gaps down, and that falling window becomes a potential resistance area. Okay, safety first trading. Okay, these are strong candles. So here we have we talked about earlier, in saving capital. Here we have safety strong candles over here, but the falling window. So the market has to close above the high of the falling window to really get bullish on this market. And actually, this is what happened after. Now, in the West, we have rounding tops and rounding bottoms. Just makes sense. The market rolls over, going from higher highs to the same highs to lower highs, or it rounds down, it rounds out. Concave, convex. Market is selling off, makes lower lows, makes the same lows. The market's getting a little less negative and makes higher lows. And the Japanese add another dimension, which I like, by adding windows. And they have some, I don't know why, but they have some food terminologies, a fry pan bottom and a dumpling top. And don't worry about remembering this. Essentially, a fry pan bottom is a rounding bottom with a gap higher. And I like that because that rounding bottom is showing us the market is gradually increasing strength. And the final kicker is that gap higher. A dumpling top, once again, just think of it as a rounding top. Market is rolling over, and the downside, the final confirmation, would be that gap down. Okay, makes sense, right? Bears are just taking over, and so aggressively you have a gap down. So here's a fry pan bottom, a rounding bottom. I just love the terms, so that's why I use them. A rounding bottom and a gap higher. The gap became potential support. Okay, here's a rising window. Didn't work. Okay, but interestingly, look, you have a falling window here. See, by the way, you have a window here, a falling window here. It doesn't mean the market's always going to get to the window. Okay, a little window, very hard to see. Again, with the green W. Nice rounding bottom, going from lower lows to about the same lows and then higher lows. And then a small rising window. Okay, a very large window here. Okay, here's a falling window. And the way I would be looking at this is, let's say we're on this day here, we have a bullish engulfing. Why would we not be buying on this bullish engulfing pattern here? The window. See it? Assuming it's not above the window, which I don't think it is. If you're buying here, aren't you buying right at resistance? How many would do that trade? Nobody. Right, not now. That's right, not now. I would have done that yesterday. And that's what it's all about. Not now, but I would have done it before. So we have a bullish engulfing pattern. This rising window becomes my first resistance. If the market gets above it, which it ultimately do, I'd make this R1. Actually, I'd have the change of polarity R2, but we're not discussing that yet. We'd make R1, and then this whole window here is R2, second resistance area. So for quite a while, this window became resistance. Ultimately, it did get above it, but this large window kept the upside rally in check. Again, you can see, look at the advantage of the small window. See that tight resistance area as opposed to this big window? Now, simplifying candle analysis. These are all patterns that I've talked about in my books. I don't talk about them anymore because they all have windows in them. So all you got to do is remember the concept of windows. So an upside gapping Suzuki, that's what it looks like. Okay, it's actually a bullish signal, but all you need to do is see there's a rising window. Okay, all the other signals here, down gap, parallel white lines, they're actually, the market gap's down, you have two white lines. It's actually a negative signal. The Japanese view that as short covering. But you don't have to worry about that. Why is it negative? The window. Okay, all these patterns, the downward gap in Suzuki, market gaps down, the white candle pushes above the falling window, completes the pattern. So we close above a falling window. The up gap parallel white lines, actually, the Japanese view, it's interesting how they view this as negative and this is positive. This they view as short covering, this they view as longs, new longs buying. But anyway, this is a bullish signal. All you have to do is know about the gap up. So that's the goal here, simplifying candle analysis. You don't have to worry about these, just remember the window. So let's look at what we learned. We looked at continuation candles. So we looked at the rising and falling three methods. We looked at windows. We touched on the essentials a little beyond in windows. Again, there's so much more you could do with windows. But we looked at the essentials. Large versus small windows. We could see why the small windows become a better trading vehicle because it's a much tighter support or resistance area as opposed to a large window. Just remember, if you have a really big window, if you have a big rising window, the bottom of that gap, or it's true with all gaps, the bottom of that gap becomes a support area. So if you have a really big rising window, while that whole zone is support, if you're buying in that window, realize your risk is to the bottom of the window. Okay? And I've tried looking at if corrections stop within 50% of the window. If there's a big window, it just doesn't work. All you can tell is that the bottom of the window is the major support. You don't know how far in the window it's going to go. That's why I like the small windows. Windows in rounding tops and rounding bottoms. Rounding bottom and then a gap higher. Fry pan bottom, dumpling top, rounding top with the gap down. And simplifying candlestick analysis. You don't have to worry about all those other signals that we talked about. Just remember the window, the basic concepts with the windows. So we move up a little bit more. We're getting about halfway there, which is funny because we're half done. Isn't that a coincidence? Now, in the next session, tomorrow, we're going to be talking about Western technicals and trade management. Let me show you why that's so important. And this is a true story. And I use this chart a lot because it's just so classic. Somebody knew about the candlesticks, okay, and they knew a shooting star was negative. And I don't answer questions from the public. I just don't have the time or the staff to do it. But this was so important that I got back to him. But actually what happened was he had my book. And on a knowledge level from 1 to 10, the books will take you to about a 2. So he had enough knowledge to be dangerous. He knew the shooting star was negative. So he saw the shooting star. He sold in the shooting star. The next day, he got out at a loss. All right? And he emailed me and he said, well, the candles don't work. The market rallied after the shooting star. And I said, before you criticize something, make sure you understand how to use it. Of course, the candles are not 100%. We saw instances where they don't work, and that's why we talked about stops. But make sure you understand how to use it. Candles are only one part of the trading triad. We have the candlestick charts, we have the Western technicals, and we have trade management. I said, I think this looks like a great trade from the short side. It's a shooting star. He knew about the first leg, the candlesticks. Let's think about Western technicals, and again, that's going to be the focus tomorrow. What is that shooting star confirming? Resistance. Okay. Whoops, sorry. A resistance area up here. Everybody see that? Yeah. Now, based on what we learned today, if you have a shooting star, what is your risk if you're short? To the high of the shooting star. And this is something really important. A lot of traders, and I was just shocked to see how common this is, that people will think that if you have a candlestick signal, and I'm sure many of you thought this before you came today, not now, but previously, they would think that if you had a candlestick signal, the next day the market would react or act the way the candlestick signal implied. I.e., you have a hammer, the next day the market's going to rally. You have a shooting star, the next day the market's going to sell off. Wrong. If you're buying on a hammer, what's your risk? The low of the hammer. If you're selling on the shooting star, what's your risk? High of the shooting star. The next day the market may rally. Should you still be in that trade? Yes. Right there, because why would you be out of that trade? Did the market get above your resistance area? No. And then after that, he bought all my educational resources. So I'm glad I answered him. But this is why it's so important. What we've looked at today is correctly recognizing the candlestick signal, but he knew it as he did, but now how to use it. And that's what we're going to take you to tomorrow when we just discuss the second and third legs of the trading triad. So I want to thank you. How did you enjoy the seminar? Great, okay.
Congratulations on completing Volume 1 of the CandleCharts.com educational resource. Now it's time to watch Volume 2, where Mr. Nissen reveals how to boost your trading success by adding Western tools and trade management with candles. If you don't yet own Volume 2, see the Ready for Next Step sheet included with the handouts of this DVD, or visit www.candlecharts.com for details about special pricing and exclusive bonuses.